Welcome to today's deep dive. I'm so glad you're joining us because we are decoding a really massive, deeply complex financial event today.
Yeah, it's a huge one.
We are acting as your personal guide to the sheer chaos, and I mean absolute chaos, that gripped the South Korean stock market in early March of 2026.
Right. It was a historic week.
The mission for this deep dive is to figure out exactly what happens when you get this perfect storm. We're talking geopolitical tension, historic market highs colliding with sudden crashes, structural system failures, and the terrifying cold reality of margin calls.
Which is really the core of the tragedy here.
Exactly. And our stack of sources today is incredible. We're pulling all our data from a series of incredibly detailed minute-by-minute reports published by the Mail Business newspaper, specifically their March 9th and March 10th editions from 2026.
Those reports are fantastic because they don't just give you the macro numbers, they give you the actual market plumbing.
Yes, and that's why you are here, to be the calm voice of reason who can help us connect the dots between these terrifying front-page headlines and the actual market mechanics.
Happy to do it. It really is a fascinating sequence of events to analyze. We're looking at a scenario where highly optimistic economic forecasts just violently intersected with fragile infrastructure.
Okay, let's unpack this, because while some investors going into this period were literally dreaming of early retirement, a couple days later, others were losing their honeymoon funds in a matter of 48 hours.
It was a brutal reversal.
So before we look at the crash itself, we need to set the scene. What was the macro context in South Korea in early 2026?
Well, the atmosphere heading into late February was just exceptionally bullish.
I mean, the numbers were staggering.
Exactly. The KOSPI index has started the year at a very respectable 4,200, but then it rapidly broke through the 6,000 mark.
Which is a massive historic expansion, especially in such a compressed time frame.
It really is. And looking at the data from the Mail Business reports, this wasn't purely a speculative frenzy. There were actual, tangible fundamentals driving that run-up.
Right. They mentioned strong corporate earnings.
Corporate earnings were robust, specifically in semiconductors and heavy manufacturing. But the real rocket fuel was the government policy.
The value-up policy, right?
Yes. For decades, the South Korean market traded at a discount, the Korea discount, compared to global peers.
Because of the cables and the complex cross-shareholding.
Exactly. Poor corporate governance. But the government intervened. They started forcing companies to cancel treasury stock and prioritize shareholder returns.
Which basically signaled to the market that this historic discount was finally closing.
Right, and that triggered a massive inflow of domestic capital. Everyone wanted in.
So everyone is incredibly optimistic. The market is at 6,000, and then the Middle East crisis hits.
Yes, the external macro shock.
The sources mention a severe escalation. A U.S.-Iran war breaks out, and Israel bombs an Iranian oil depot.
Which instantly fractures the global geopolitical landscape.
And the immediate reaction in the commodities market is exactly what you'd fear. Oil blasts past $100 a barrel.
Which is devastating for South Korea.
Because they import all their energy.
Right. Almost entirely. It's a heavily industrialized, export-driven economy. When crude oil stabilizes above $100, it instantly compresses operating margins across the board.
From petrochemicals to semiconductors.
Everywhere. But the secondary effect of that geopolitical stress is equally damaging.
The currency devaluation.
Right. Global capital instinctively flees emerging markets during a crisis involving the U.S. and the Middle East. It seeks the safety of the U.S. dollar.
And the Mail Business data shows the $1 exchange rate edging dangerously close to $1,500.
So you're importing $100 oil, but your purchasing power to buy that oil is deeply degraded by the weak won.
It's a double whammy. It squeezes the exact corporate balance sheets that had just driven the KOSPI to 6,000.
And the market reaction was immediate.
Catastrophic, really. Let's look at the brutal numbers. On March 3rd, the KOSPI plummeted 7.24%.
A massive single-day drop.
And the very next day, March 4th, it dropped a staggering 12.06%.
So a combined contraction of over 18% in 2 days.
If we connect this to the bigger picture, it just demonstrates how powerful global liquidity is.
It really does. It fundamentally does not matter how pristine local corporate balance sheets are, or how great the government policies are.
Right. When the shock hits, international investors just dump everything.
They de-risk globally to raise dollar liquidity, and that massive outflow just overwhelms the domestic market.
But the sell-off wasn't just a numbers game. The actual structural integrity of the market broke down.
The tech failure.
Yes, on March 9th. Right in the middle of this massive market drop, the Korea exchange system, the KRX, glitched.
Which is the absolute worst time for infrastructure to fail.
The reports highlight specific times, between 12:3 and 12:33 p.m., and again from 1:39 to 1:41 p.m.
The actual matching engines faltered.
Orders were delayed or just outright rejected. Mirai Asset Securities had to send out urgent warnings to their users,
telling them to manually check if their trades went through.
Think about the psychology of that for a second. Put yourself in the listener's shoes. You're watching your portfolio bleed out, you finally hit sell to stop the bleeding, and the system simply says no.
It shatters the fundamental premise of electronic trading: immediate liquidity.
Even though the glitch was short, like just a few minutes, the panic it causes is profound.
Because investors no longer trust the system. The moment it comes back online, they dump everything at market price just to guarantee they get out.
Which pushes the market down even further. And this brings us to the real tragedy of this event. The Bit 2 phenomenon.
Bit 2. Debt investing.
Leveraged investing, right. The Mail Business reports emphasized that margin loans had reached record levels.
Retail investors saw the initial dip and thought it was a buying opportunity.
Buy the dip. But they did it with borrowed money.
Right. Leverage is a magic wand in a bull market. It amplifies your gains.
But it is the first thing to crush you in a bear market.
Because time is no longer on your side.
The sources share some really heartbreaking human elements here. We're not just talking about discretionary income.
No, we're talking about essential life funds.
One investor pulled out their GNZ deposit, their housing lease money, and lost 30 million won in a single day.
Deploying a Jonesy deposit into leveraged equities is a staggering miscalculation of risk.
Someone else lost 18 million won on a Cocoa's PI leverage ETF. And a couple saw their 500 million won honeymoon and house fund shrink to 200 million.
It's devastating.
How would you react if your housing money just vanished on a screen? It's unimaginable.
It shows a total breakdown in understanding asset liability. You cannot put short-term necessary capital into highly volatile leverage trades.
Here's where it gets really interesting, though. The actual mechanics of how they lost that money so fast. Let's talk about the T+3 settlement cycle.
Right. The Missouri or margin trade. It is a strict automated timeline.
Walk us through it. What happens on T-Day?
So on T-Day, the day of the trade, you buy shares using borrowed money. You expect the price to go up.
The broker is spotting you the cash and using your shares as collateral.
Exactly. Then we move to T+2, which is settlement day.
Okay, what happens then?
By the close of business on T+2, you have to resolve the debt. If the stock went up, you sell, pay back the broker, keep the profit.
But if the stock went down, like it did in this 18% crash,
then your collateral isn't worth enough anymore. You have to wire fresh cash into your account to cover the difference.
And what if you don't have the cash? Because you already put your whole GNON's deposit in.
That brings us to T+3, the forced liquidation, the ban de meme.
And you have zero control at this point, right?
Zero. You are locked out. The brokerage's risk management algorithm takes over. It automatically sells your assets at market price right at the opening bell.
To cover the debt, it doesn't care about the stock's fundamentals. It doesn't wait for a rebound.
It just blind sells.
Which brings us to the staggering data from early March. Let's look at the numbers of this death spiral.
The numbers are terrifying.
March 5th. Margin loans hit an all-time high of 33.69 trillion won.
Just a massive amount of leverage sitting in the system.
And on that same day, unpaid margin balances, the money people couldn't pay on T+2, jumped 78.5% in a single day,
reaching 2.1488 trillion won.
And so the very next day, March 6th, actual forced liquidations hit 82.4 billion won. The highest in 2.5 years.
What's fascinating here is the vicious cycle this creates, the death spiral.
Walk us through the steps of the spiral.
Step 1, the market drops because of the geopolitical shock.
Step 2, collateral values fall below required limits.
Step 3, brokerages force sell shares at T+3 to cover the loans.
Step 4, that flood of forced selling pushes the market index down even further.
And step 5, that new lower price triggers a whole new wave of margin calls for other investors who thought they were safe yesterday.
It just feeds on itself, a constant loop of selling.
Until the leverage is completely flushed out of the system.
It got so bad that the authorities had to step in. The Mail Business notes that Financial Supervisory Service Senior Deputy Governor Lee Si-hoon called an emergency meeting on March 9th.
The FSS was terrified of systemic contagion.
They demanded daily monitoring of fund flows and margin loans. They were worried about the financial sector's actual soundness.
Because if the forced selling doesn't cover the loans, the brokerages start taking the losses directly.
Right, and the brokerages didn't wait around. NH, KB, Korea Investment, they literally pulled the plug.
They temporarily halted new margin loan transactions entirely.
To stop investors from throwing more borrowed fuel onto the fire.
It was a blunt instrument, but necessary to break the mathematical feedback loop.
So what does this all mean? We've talked about a crash, system glitches, and a death spiral of forced selling. Is the Korean economy actually broken?
Paradoxically, no. The sources show the fundamentals are actually incredibly strong.
Right. The panic was about liquidity and leverage, not the actual companies. Nomura Securities was out there predicting the KOPI would hit 8,000.
And the math supports that. Take Samsung Electronics.
The sources say Samsung was projected to hit 160 trillion, in operating profit. With whispers, it could reach 200 trillion.
That is monumental free cash flow. And the price-to-earnings ratio, the PER, was only around 10x.
Which is not historically high at all. It's actually cheap.
Exactly. You are buying a highly profitable manufacturing base at a discount.
Plus, macro politics were actually helping South Korea.
The U.S.-China tech war.
Right. The U.S. shielding its markets from Chinese tech meant a massive benefit for Korean manufacturing.
Korean foundries and battery makers were capturing all that diverted demand.
Add in the government's aggressive value-up policies forcing money from real estate into the financial markets.
And you have an incredibly bullish structural foundation.
Which explains the FOMO, the fear of missing out.
Right.
If you're sitting in a safe bank deposit, watching this happen, watching the index hit 6,000, you feel like you have to get in.
Mm-hmm. And that FOMO is why they used the leverage. They identified the right macro thesis, but used the entirely wrong instrument to execute it.
Which brings us to the survival guide. How do you survive a market like this?
The mail business included some great advice from Kim Lusuk, an executive at KB Goldie & Wise.
Let's distill her rules down. Rule 1. Never invest money you might need in the short term.
You must be able to lock it away for 3+ years.
To ride out the index's historical upward curve. So no Chauncey deposit money.
Exactly. Rule 2. You must possess the psychological fortitude to stomach a 20% drop without panicking.
Because 20% corrections happen. It's part of the cycle.
If you aren't prepared for it, you will sell at the exact bottom.
Rule 3, and this is the big one based on today's deep dive. Avoid the extremes.
No leverage, no debt.
And avoid inverse or 2x leveraged ETFs.
Yeah.
Just stick to single direction long-term investments.
Because if you don't have margin debt, the T+3 algorithm cannot touch you. You just hold your shares and wait it out.
Rule 4, dollar cost averaging.
Set an automatic monthly transfer. Don't try to time the market.
And she says, when you hit your goal, realize the profit and start over.
Systematically sweep that liquidity off the table.
Finally, Rule 5. Keep cash on hand to act as a buffer during adjustments.
So when the market drops 18%, instead of getting a margin call, you can actually buy the dip with real cash.
And she advises looking at diversified index funds, or the new value up index, rather than picking volatile individual stocks.
It limits your idiosyncratic risk.
So, to summarize, we have this massive macroeconomic picture pointing to huge growth of Samsung's profits, the government policy.
But relying on borrowed money turns a brief geopolitical panic into a permanent personal financial wipeout.
Exactly. A temporary dip becomes a realized loss you can never recover from.
This raises an important question, though, something for you to really think about.
What's that?
We spent all this time talking about retail investors being forced to sell by computer algorithms at T+3.
Right. Billions of won in forced liquidations.
But every trade needs a buyer. If incredibly valuable companies are seeing their stock plummet simply because retail investors are being forced to liquidate.
Who is sitting on the other side of those trades?
Exactly. When the dust settles and the panic clears, who is buying up these highly profitable companies at absolute bargain basement prices?
Because the retail investor wasn't allowed to hold on?
It's the institutional money. They are scooping up generational wealth while the retail guy gets wiped out by a margin call.
That is a chilling thought. Definitely something for you to think about next time you consider borrowing money to quote-unquote buy the dip.
It completely changes how you view a market crash.
It really does. Well, thank you so much for joining us on this deep dive into the March 2026 crash.
It was a pleasure unpacking this with you.
We hope this look at the mechanics of leverage and forced liquidations helps you navigate your own financial journey safely. Stay curious, stay informed, and we will see you next time.